Hey guys, welcome to another episode of Abe's Finance. And today I want to talk about some of the market risks that I'm seeing increasing as we speak in the markets. Now, I don't want to panic, you guys. I'm not going to say it's going to crash. I'm just saying some of the things that's on my radar is popping up on my radar. And the first thing, I just want to follow up on Archegos Capital Management. And I'm sure you've seen it on the headlines in the last couple of days. And I think that's starting to run through the headlines and it's going to be, no big deal. The banks are going to cop a bit of losses and then everything's hunky dory. Now, I don't necessarily think that. I do believe that the risk departments in all the banks are going to assess all the risk, and perhaps this is one of those risk-off type of mentalities that's going to come into place into the markets rather than risk-on, especially after something like Archegos, which was literally Goldman Sachs looking at their risk or the balance sheet and going, you know what, it is time to go risk-off, and then they literally caused the crash as a result of taking risk off. And they've started this new trend. I wouldn't be surprised if they continue with it. And there'll be other banks looking to perhaps, like, Nomura, who lost 2 billion, or something like Credit Suisse, maybe they want to get some risk off their books, just in case further downside like this happens again. This is the way the banks are thinking. So, unless, of course, there's enough liquidity to stop this happening. And at some point, there probably will be. But liquidity usually happens after a bit of a crash, if you know what I mean. That's how, the central banks get a little bit scared. So they actually start printing like crazy and they don't worry about inflation. They can justify whatever money printing that they need to do to save the world economy or their own economies because they don't need to care about inflation, because who cares about that? We've got a pandemic, we've got a recession. Inflation's not going to come in, is it? Maybe, maybe not. Now, I'm actually going to go contrary to most people, and even to where you might be thinking I'm going. I actually think inflation's not that big of a deal, as crazy as it sounds. Because, from just from what people that I've heard and what they've said, is that inflation is going to drive real estate up into stratospheric levels, or it's going to take Bitcoin to the moon, or it will never get into the stock market. Yada yada yada. It will. Perhaps that's the case. I don't necessarily think so, because if we start looking at some of the economic data and what the Wall Street as well as the central banks look at, which is namely the CPI numbers, the official economic releases, and I'll just quickly show you, they're not really showing inflation. The way they measure inflation is not really showing up. Average hourly earnings, let's look at the last 2 months of data. Average hourly earnings, that's only increased by 0.2% in early Feb. Economic releases like CPI, Consumer Price Index, month on month, that's 0.3. So that's, I don't know, if you annualize that, that's about 3.6%. Year on year for the UK is only 0.7% inflation, according to their numbers. What is it? Core CPI in the US, which came out in March 11th, month on month, that's 0.1. That's less than 0.2 that was projected. So we're undershooting with inflation according to the numbers. You look at the Canadian release, CPI month on month is 0.5 versus 0.7. Having said that, 0.5 is actually quite high, because if you annualize that, that's like only 6%. But what I am getting at is that most of these CPI numbers are actually underwhelming the expectations. And so that means that Wall Street sees there to be less inflation, and it's, the stock market will react as if it's deflation, a little bit of deflation or disinflation. So if we get even less inflation, the market sees this potentially as the economy is cooling down even more and we can't really justify these asset prices. So that's something to bear in mind. And if you look at the price action of the stock markets, this is the US stock market, and especially since November, we've kind of slowed down a bit. You can see the curve of the upside. It's starting to slow. It's about to curl the other way a little bit. If it keeps curling in this trajectory, it will go the other way. And we've actually had two stimulus checks, sent out since the election, the US election, and we haven't really moved as much as if you look from where my cursor is, from 2,200 all the way up to 3,500 by from April to September. That's 1,300 points. I think, yeah, from 2,200 to 3,500. Now we're at 3,900. From 3,500 to 3,900 is 400 or so points. And we've done that's in 6 months. But the 6 months before that, we went up 1,300 points. Now we're only up 450 points, right? So you can start to see the stimulus is starting to wear off. And there's a theory that the day traders are not day trading as much because some of the states are not completely locked down, and instead of being stuck at home day trading with their stimulus checks, they can go out and spend and have fun with their friends, which are good things. And they can, they can go back to work and stuff, so that they're not sitting in front of the computer day trading. So that might be another factor. The liquidity that's being stimulated, that's set in the stimulus checks, aren't going into the stock market as much because there's more things to do in a less locked down society. So there's another reason, another headwind for this market rally. What else is there? This is what I really want to talk about. The dollar, the US dollar. Now, most people might not think about it too much, but excuse all those drawings. I do a bit of technical analysis on there. But in fact, what I will do is I'll get rid of these. Now, I want to show you something very important, and that is, where is it? Here we go. Now, I'm a believer and operator with levels. Basically price points that the market doesn't really want to break. If it breaks or if it changes past this price, it signifies a lot of things. And for one, we can see here a horizontal line around 94.50, 95 bucks. And here, just really approximately, we have probably $92.50. Now, from March to April, around that period, we've just been seeing the US dollar dropping, right? Non-stop. But something's changed. See, if you look at here, it's actually broken the $92.50 level. Very, very, I'd say quite convincingly. Without any hesitation, it just snapped right through it. And you can also see this red line, that's the 200 moving average. Every Wall Street institution does look at this 200 moving average, and it sliced right through it like a hot knife through butter. So that tells you that the US dollar is picking up steam, right? If there is inflation, then this would come back down, right? The people, Wall Street, everyone looking at 200, the 200 moving average. And if they truly think that, you know what, US dollar is going down because it truly is inflation, this would at least stop at this, this red arrow that I've just drawn here. But it hasn't. It hasn't. Now, this is not conclusive, but it is, I'd say, like over 70 to 80%, like the signal is clear. Right? That's how, that's the probability we're looking at. It's a very strong signal that this idea of inflation, that's perhaps over. Now, let's look at another chart. Let's look at the bonds. We're looking at the 10-year bonds. And just bear in mind, when this goes down, interest rates are going up. So if we can see the interest rates, they're they have been going, up because this chart is going down. So the bonds have been going down, but I'm just starting to see perhaps we are approaching a very strong level at 131. And I know this might look like I'm over extrapolating something out of it, but it's actually slowing down. You're seeing more and more couple of cycles and waves, and it hasn't pushed through this point. Yet, might I add, the US dollar has completely shot up through that major level. Now, I think that this might be next. This is a very nice pullback for any people on Wall Street who wants to buy the dip. Anyone who wants to buy a dip, they're seeing this is a beautiful dip at a beautiful level. They're going for it. Now, should you buy bonds? Maybe. It's not financial advice. But when bonds go up, US dollar goes up, it tells you that inflation isn't the inflation story that's been driving our stock markets and commodity markets isn't on the table so much anymore. And if it's not so much on the table so much, this inflationary, stimulus of the stock market, then without the stimulus, what's going to happen? Right? Without the pump, what's going to happen? Perhaps we're going to get a dump. And that is kind of like my theory, because we just had it too good these days. We've had it very good. And you might go, this is a lot of conjecture, yada, yada, yada. I don't believe you. Well, let's look at the Asian and European markets, and we're starting to see an interesting story. We'll quickly go into Hong Kong. Let me get, my apologies. HK, I think 33. Yes, this is a nice. We're seeing, we're already seeing a massive drop in Hong Kong over the last month or so. We're already seeing the dip in Hong Kong. When we go to something like China, let's look at the Chinese stock market. And look, it's already been crashing, right? So since early February. So that's already happened. So this is, I like to say that, I'm ahead of the curve and before the news. But, for some markets, this is old news. Let's talk about DE30. I think it's the DAX. I think this is a good one to see. Now, the German market is the exception. I think some of the manufacturing is really kicking into gear. So they're looking good. But really, we can look at the UK, the FTSE 100, and we'll see that it hasn't really returned to the highs it reached in early January. It's just been chopping around. So, a lot of the Asian markets and the European markets aren't really showing any great signs. It's actually showing a lot of slowing momentum. And finally, home ground, I'm going to talk about the Australian markets. It hasn't gone anywhere, as you can see on the chart, since October, basically. Since late November. Early December. For the last 3-4 months, it hasn't gone anywhere. So that's a sign of us losing momentum. The stimulus checks aren't working as much. The people aren't day trading as much and putting as much of their money into the markets because they're going out there and living their lives. We're talking about, Goldman Sachs and other, banks. Why did they start Archegos? What inspired them to take risk off the table? You've got to ask yourself, right? Because maybe they see something coming. Maybe they see this inflation story is over. Maybe they see, I don't know, we've gone up too high. Maybe they see that the day traders aren't pushing the market up anymore. Maybe they see the stimulus isn't really working. So maybe they see, and I'm sure they do see, what's happening in the Asian markets, what's happening in Australia, right? What's happening in the European markets, with the exception of with Germany. But the UK is weak too. And also if you look at NASDAQ, NQ, I think NQ is a good one. NASDAQ, we've had the tech wreck. That's, I love how like a lot of US, traders and investors, they get so panicked when they see this little dip. And then you can look at something in China or, in Europe or something like that. And, it's so much more dramatic. So, this is nothing, and they panic. I mean, what happens when there's a real crash? How can you panic for this? But not to say this is not insignificant. This is how big is this drop? Let me see. This drop is, it's 10%. It's hardly a correction. But let's be honest, this also adds to the story of maybe there's a little bit of weakness. And before I go to another asset, look at it's not breaking above the 50 moving average, which is the blue line. It's gone up. Nope. It's, in fact, these subsequent waves are less high. They're weaker and weaker. So the market is weaning off and getting away from this 50 moving average. It's the buyers not coming in. They're not willing to push it. They're less and less willing to push it up. That tells you that maybe the downside is to come. Now, by the way, I don't want to push my agenda or my thesis onto you guys. It's just food for thought, because there's got a lot of people on YouTube and on, just the media, the financial media in general, that they will tell you to buy the dip. And I agree to that to some extent. It's better than buying highs, absolutely. But let's have a rational, longer-term picture look at the market rather than just say, hey, buy the dip. Because how many markets look like this, straight up, and you can buy every dip? It's not the case. You can go back in history, and there are not beautiful buy the dips. I can show you markets that haven't gone anywhere for a decade, right? It just happened to be 1 year we've gone up a decade's worth of stock market in 1 year. We've doubled the price of the stock markets in 1 year. That doesn't happen much. So you look at a couple of these things put together, and I think that perhaps the narrative in the market is shifting. Anyway, I don't want to force this opinion on you guys, and I'm not necessarily trading, I'm not shorting the market, but I just think this is an interesting new perspective that, maybe people haven't come around to yet. And maybe, if you're smart, you might be able to make money off it. You might be able to short or buy puts or buy volatility, or, the rest is up to you. Or you could just buy the dip and it keeps going up, and I'd be so happy for you too. But I do think that the standard narrative of, it's going to keep going up because there's stimulus checks coming out and there's inflation. I totally disagree with this idea of inflation, at least in terms of the market, in terms of Wall Street. But I do completely agree that when I go to the supermarket, everything is more expensive. When I put petrol in my car or gasoline in my car, it's more expensive. I'm not going to disagree with you guys. No way. But Wall Street and what the market looks at and what the central banks look at and whatever dictates their policy, there is no inflation. If there's too little inflation, if there's deflation, it might drop, or it gives them an excuse to pump it up again. But, we'll see about that. And also they already had, people were already freaking out about inflation anyway. So I don't know if they really want to pump it so much with liquidity. Who knows? That's probably a little bit too much speculation for today. Regardless, I hope you got something out of the video. If you did, please hit the like button, and please entertain the idea of subscribing too. I'm trying to build up to 1,000 subscribers. That'll be so helpful. I'm not going to invest even more into this channel. And finally, if you got any feedback on this channel, that's really cool too. Just pop it into the comments. And take care, and I'll see you in the next one. Have a good one. Bye bye.